Hello, everyone, and welcome from wherever you are in the world. Thanks for joining today's timely webinar, co-hosted by Shell and BCG. I'm Katie Sullivan, Managing Director at AIDA, the International Emissions Trading Association. For over 20 years, AIDA has been the business voice for the intersection of markets and climate change. On behalf of our 200 members across the carbon value chain, I lead efforts to inform market solutions to address climate across the Americas and with my team globally. I'm honored to moderate today's session, where we'll explore highlights from the UN climate talks in Glasgow and the rapid evolution of the world's voluntary carbon market. Before we begin, a little housekeeping. On your screen, you'll see links to download the new Shell BCG voluntary market reports. You'll also see more information on our panelists and the ability to enter questions. We'll have an open Q&A session at the end, so don't be shy. Feel free to send questions over the whole course of the discussion. Also, you can make the media player full screen by clicking on the top right of your media player widget. A quick security moment. Make sure that you're joining us from a safe place throughout the event. For those at home, make sure your workspace is ergonomically friendly, and in case of emergency, you have an evacuation plan. For those at the office, note the location of the closest emergency exit. If you hear an alarm, leave the webcast and follow instructions of your safety wardens. Now, I'm delighted to introduce our fantastic speakers. We have Bill McGrath, General Manager of Shell's Global Environmental Products Division. Since 2012, Bill's expanded the business from only London to now 4 global hubs serving 14 environmental markets. We also have Jesper Nielsen, Managing Director and Senior Partner at BCG, where he leads the group's social impact practice. We have Anders Porsberg Smith, Managing Director and Partner also at BCG, where he's Global Lead for Commodity Trading and Risk Management. And last, but certainly not least, we have Christopher Webb, Global Carbon Markets Director at the Nature Conservancy, or TNC, where he focuses on market solutions for natural climate solutions. So let's get things started. I'll first hand it over to Bill to provide a quick introduction and share context on how Shell and BCG partnered on their new voluntary carbon market reports. This will be a really great starting point for today's discussion. So Bill, over to you.
Thank you, Katie, and welcome to everyone. And thank you for joining us in this discussion on the voluntary carbon market. Tackling climate change it's an urgent challenge. And while businesses are looking to play their part in developing strategies for reducing and avoiding emissions towards zero, for many, reaching zero simply isn't possible with the available technologies and solutions. Indeed, in some sectors, practical alternatives have yet to be developed. Carbon credits can help close the gap. That they can. But let's be clear, carbon markets and offsetting are not a substitute for avoiding or reducing emissions. Yet, the world cannot simply wait and allow cumulative emissions to grow while businesses develop the solutions for the future. Carbon credits allow businesses to act now and make a difference now. As such, they can be a vital part of the decarbonization solution. As more businesses turn to carbon credits, we all have an interest in ensuring that the credits used are of the highest quality. To do that, we need a carbon market that provides more high quality carbon credits while retaining credibility and consumer confidence. The market needs to develop and mature if it is to meet the needs of a growing number of customers. Working with BCG, we wanted to better understand what a successful market might look like in the future. BCG, in turn, sought the views of 116 industry experts to help ground their analysis in the practical experience of those who are developing and implementing sustainability strategies for business every day, today. This led to 2 reports, the first of which, titled An Outlook on the Voluntary Carbon Market, is an examination of the market and the way in which different scenarios for its futures could develop. The second is a strategic approach to using carbon credits, which sets out a framework for businesses as they consider how to engage with this market. We also put together a third report, which is ensuring high quality nature-based carbon credits. This captures the lessons we, Shell, I've learned over the past half decade in interacting with the market, both as supplier and consumer, and the steps we take to secure high quality supply. It won't have passed you by that in addition to the publication of these reports, the past few weeks have been significant for climate discussions. With COP26 concluded, this seemed like an opportune moment to look at what has been achieved in Glasgow, what it means for some of the scenarios we put forward in the Outlook report, and the implications for businesses as they develop their carbon neutral pathways and resultant offsetting strategies. I'm delighted that such a variety of businesses have joined this webinar. Please do get involved and ask questions, and get in touch with us after the session. We want to continue the conversation, and we hope help scale up a transparent, verifiable, and effective voluntary carbon market. And through that process, support our customers in their decarbonisation journeys. And with that, Katie, I'm going to hand back to you to set up JESPA.
Excellent. Thanks very much, Bill. I think it's a perfect way to start us off. And it's great to see a broad range of organizations join us today from across sectors and borders. We really are at a pivotal point for carbon market growth and activity, but it's absolutely critical that as the voluntary market scales and interacts with compliance markets, we work together to enhance its transparency while also ensuring integrity. Now I'm going to hand it over to Jesper from BCG, who only a few weeks ago, although it seems like a few months ago now, was actually on the ground with me and the team at COP26 in Glasgow. Jesper will share his main takeaways from the UN talks, including the long-awaited, hard-fought outcome decision on Article 6 of the Paris Agreement, a framework that should have tremendous impact on carbon markets, and an article that AIDA's community certainly holds near and dear to our hearts. So Jesper, over to you to tell us what happened at COP26.
Thanks, Katie. I think, David, if we can put up the slides. Look, I very often get asked, was COP26 a success or was it a failure? My short answer is that it was a success in the political context. I think it exceeded reasonable expectations. But it's obviously not enough. It's not enough to really hit 1.5 degrees. And I think, you know, coming out of the conference, I think we all know that it is barely alive. I do think that one big positive was that I think all major governments and a lot of the big businesses, the whole financial communities are now aligned around the shared goal on net zero. And I think that combined with the urgency that we have in terms of climate, I think that means that we will see an acceleration of the climate transition. I think we will see exponential growth in the energy transition, and we will see exponential growth in carbon markets as well, including the voluntary side. One thing that I also discussed with many people at the COP was the need for a demand side claim for the journey to net zero. So just before COP, SBTi came out with their net zero standard. However, it doesn't talk about the journey of actually getting there besides a science-based abatement pathway in value chain. I think that we will see over the next 12 months a claim coming out that is deemed as credible that will address also the compensation side of the journey. And I think that will be another major demand signal to corporates and help fuel the market. And lastly, and most importantly, we obviously had finally an agreement on Article 6. And I think that that is a demand signal both for the compliance market, obviously, but it will also have spillover effects for the voluntary side. And I think likely to lead to a convergence over time. And if we go to the next page, I'll talk a bit more about that. So first of all, I think that we will see a lot more demand on the compliance side. So clearly we'll see Article 6.2 transactions. Switzerland is starting to pioneer that. I think that we'll see some regional ETS schemes incorporating the ITMOs into their schemes. On the voluntary side, I think we'll actually see some corporates starting to use the compliance products, the ITMOs, for voluntary purposes. I think we will especially see this in the tech sector and the consumer sector, where they will try to strive for the highest possible quality of credits. This will be including corresponding adjustments, which is obviously one of the big questions for voluntary markets now. I think questions around that will continue at least for a while, and will create some uncertainty. We have gold standard going one way, as we know, and various now debating what way that they will go. We think that the most likely scenario is a tiered marketplace, where at the top we have the ITMOs, and then we'll probably have different types of voluntary products priced off that sort of benchmark liquid ITMO. And that could very well include products that essentially are built on the same methodologies as the compliance market, just without the corresponding adjustment. And this is what point 5 here is all about. I think that we see over the next 3 years, we would see a convergence of methodologies used in the new so CDM 2.0 mechanism, and over time that the voluntary market will mirror those same methodologies. I think it would be difficult for any corporate to have difference of quality between the two types of offsets that they will be using. So I think that will mean that we will transition to what we call the linked market scenario on the next page. This, we think, is the most likely scenario. It will mean that we will have at least 1 gigaton per year of demand by the end of the decade. But honestly, it could be a lot more than that. I think every time I look at this, my demand forecasts go up. And obviously, if we get that claim standard I mentioned, if we get these links to the ETSs, I think that we will easily see 2+ gigatons per year. And that will obviously make a real difference for our fight against climate change. Demand is likely to exceed supply, leading to a shortage. I think to fill that shortage, we will need quite large-scale RED+ projects. I think that's one of the only real levers to get to these levels of supply that's necessary. But even so, we will see price increases, both because of the shortage, but also because these higher prices are necessary to really unlock that supply. For the compliance part of this, I think actually we'll see even higher prices, because the corresponding adjustments will mean that supply will be even more limited. I think we will see governments, retain some of the lower cost projects for themselves or locally, and therefore we'll see that international projects will have to go up the cost curve in terms of abatement, and therefore drive prices up. So now that does create some risk, I think, to the demand. I think we are very confident in demand at the sort of up to $20 a ton. But if we're talking $30, $40 a ton, or even $50 a ton, I think we need to see what happens on the demand side for the voluntary purposes, obviously not for the compliance purposes. So in summary, we think that COP26 is a significant demand signal for carbon markets. We think that the voluntary carbon markets will grow exponentially, and we see convergence with the compliance markets, with the voluntary markets increasingly mirroring what happens in the compliance markets. Thank you. Back over to you, Katie.
Thanks so much, Jesper. Great insights, crisp overview from Glasgow and leaning into markets and Article 6 and what the future could have in store. I think you've set the stage perfectly for our panel discussion, where we're going to dig deeper into the COP potential impacts on the VCM and outlooks for what's ahead. Thanks for joining us, and hope to see you again, hopefully before Sharm el-Sheikh in Egypt next November at COP27. Thanks again, Jesper. And I'll ask,
thank you.
Thank you. And I'll ask the rest of the panelists, Bill, and we have Anders and Chris. Join me on video. Excellent. So some great scene setter presentations from Bill and now Jesper. And let's start with just the segment on COP26, recognizing many people are still digesting what's coming out, and we're seeing these reflections and briefs on what seems to be a daily basis now since Glasgow, including from some of these key standards out there like Gold Standard and Verra, and I know ACR is coming out, and AIDA's Voluntary Hub, ICROA, will also be publishing reflections on Article 6 decisions and VCM potential impacts sometime this week. So with that, I'd actually like to first tee up Chris. And you know, Chris with TNC, fellow traveler across all these markets, and certainly UNFCCC circles. How are you and TNC interpreting what's come out on Article 6 from Glasgow, and what it means really for the BCM going forward?
Great, thanks, Katie. Thanks, everyone. Great to be here with you today. I'll say a few things, partly to emphasize some points I think have already been made that are worth emphasizing, and also spring in some things that I've heard both inside the negotiations and things that were going on outside in the broader conference. Having said that, one of the things that myself and my colleagues have been doing, and some of you may have already seen this on LinkedIn, but if not, if you find me and you'll find it, it's a sort of plain English interpretation of what we think was in Article 6. And we've put it up on LinkedIn because we'd really like to try and crowdsource others' ideas, because I think one of the things to take away is we've got a great signal on that demand side at that macro level, but the implementation, it still seems a little uncertain. So do take a look at that. Hopefully it tries to turn all of that Article 6 language into something we can all digest. But some things that I heard, I think the first point to make is this point about growth. You know, we really expect COP26 to really have given that boost to continued growth in the voluntary carbon market. Now, not just the net zero commitments that you heard, but actually the fact that governments have got Article 6 over the line, I think is a real indication at a political level that governments are supportive of markets. It's no longer if they will support them, it's these detailed rules of how. And I think that political support will be very helpful for businesses and the voluntary carbon market as it looks to further scale. Two sort of things I saw as I was walking around the conference center rather than inside the negotiations. One, I really saw a huge amount of new technology being brought to the voluntary carbon market, whether that's in satellite data for monitoring and reporting, or some really interesting uses of data to help buyers understand the risks in underlying projects and credits. And so one of the things that I think we could see is some potential disruption in the market about how it operates and how we implement it. And I think that disruption will deliver two things. It will deliver efficiencies and it will increase quality. So watch out for technology disruption. The third, and one very dear to sort of my heart and the Nature Conservancy's heart, is nature. There was a nature pavilion right at the heart of the sort of conference zone. We had billions of dollars pledged to stopping deforestation. And so really it felt, for the first time I can remember since I've been following the COPs for sort of 15 years or so, was that nature has played a really central role. And the voluntary carbon market data, you know, really supports that as well now. Nature was about 5% of the market 10 years ago. It's now over 50% of the market. Another thing that I think I was picking up outside the conference was a really interesting continual wave of market consolidation. There have been a lot of organizations that have been active in the space for a number of years now that are seeing an opportunity for growth, but are looking at M&A opportunities for how they can bring in the resources and scale to capture this opportunity. So I think that's an interesting trend to watch for. I think in turn, that's also creating space for new organizations to come in. So we've got growth, technology, nature, and market consolidation. But lastly, perhaps just pivoting back into the negotiations, you heard from Jasper there how the connections between compliance and voluntary are getting closer, that they're getting pretty blurry in places. For example, companies using ITMOs, these Article 6 credits for voluntary purposes. And there's a couple of things that I'd add there. One, the details for the Paris Agreement mechanisms are yet to be determined, but they could set the tone and direction for the voluntary carbon market. The voluntary carbon market isn't going to have to follow these, but it's very often that organizations involved in the voluntary carbon market will take some of their cues from how compliance markets are operating. So if we think about what type of projects are ultimately allowable under this new CDM mechanism, or what vintages of credits are deemed allowable or not, you could start to see how the voluntary carbon market might take some of those cues. And I think that's something interesting to watch for in the coming months and years. And then I'm sort of getting really kind of micro here. So I've started sort of macro. My last point is a very micro one. Some of the crediting periods are shortening. That's essentially the time around which you have in an initial period to sell carbon credits for your project. And in fact, we've seen some of that in the voluntary carbon market in recent months as well. And really, what that means is you've got a shorter period of time within which to make a return. And I'm interested to see if that has an effect on skewing projects to certain types or countries where that risk return suits and sits with that shorter crediting period better than others. And again, you could see the voluntary carbon market taking its cue from how that plays out a little bit. So standing back, we think there's a whole world of opportunity here for businesses. That growth really looks like it's coming. The details still need to be worked out. I think the main implication for businesses there is stick close to host governments. That's going to be increasingly important, but there's still a role for business to play to ensure the world gets these details right. So, bring your voice and your opinions. We need to make sure these work as effective tools for corporates around the world. So, my sort of plea is, please don't necessarily just stand on the sidelines. We aren't quite there yet. We've got one last push.
Excellent. Thank you so much, Chris. Extremely well said. And going from definitely macro, but really important insights on just expect the growth, right? There's going to be a wave. We got to ride it. And on the tech disruption, on broadly nature, and on how the voluntary market will start to take its cues, right, from compliance, and how now the real work it's got to get done on implementation. And Bill, we were having a little chat about this earlier, I guess, last week now, but there's been a ton of briefings. And if you've been in the bowels of the UNFCCC process and Article 6 negotiations, it's been some tough sledding. And it is a great moment, and we are embracing the package that came out of Glasgow, but really now it's time to implement and where the work really happens. So do you want to share your brief thoughts on Glasgow, what it means, and really the path forward?
So I think Chris picked up on a number of things, and let me just perhaps add some flavor around them. Look, it took us 6 years to get markets validated as a mechanism for dealing with climate change, if you will. And that's what Article 6 in Glasgow actually established. And that essentially what Kyoto created, Paris, if you will, evolves. Yeah, and I think for those of us who have been in the details of what Kyoto was, I think it's also solved some of the problems that Kyoto had. Now I think if you're also a pragmatist, you recognize that this is version 1.0. And to torch the tech analogy, version 1.0, let's just say it's going to be a work in progress. And there's quite a significant amount of uncertainty about how the apparatus for Article 6 mechanisms, whether that's what's captured in what's referred to often as 6.2, or sorry, what is 6.2 and what is 6.4, the mechanics of that needs to be worked through. And that's really, hopefully we see that initiated at COP26 and concluded in Sharm el-Sheikh next year in COP27, I mean, to set some ambition. But validated markets, the first point. The second thing, the growth potential now gets interesting because we're seeing, you heard Jesper talk to it. You're talking about a price point, well, today, let's call it 10. He was talking about 20. We're talking a market scale that has been in the hundreds of millions of tons moving to the billions of tons. What that's beginning to create is the prospect of demand that then stimulates supply reaction and is then validated within a construct that's been effectively ratified within a COP. So that provides greater confidence that Invest can produce something that has a destination. That begins to spin the wheels, if you will, of industry in solving this problem. So that's my second point. So we've got validated markets, we've got growth potential. And I would also just like to point out that the pragmatist in me has to highlight that having been through the ups and downs of these markets for more than a few years, uncertainty is rife, right? This is not a treaty that is cascaded down. That's often pointed out as being one of the Achilles of Kyoto because it didn't get ratified by a number of key players. It is an agreement that is built up and is subject to interpretation locally in that process. In other words, it has to move from an agreement framework, if you will, at the United Nations level into individual states ratifying it into legislation. So there will be twists and turns in that process. So to summarize, markets are validated. We have growth potential, but boy, don't expect the ride to be a straightforward, smooth one. There are going to be bumps. Back to you, Katie.
Thank you, Bill. Twists and turns along the way. It certainly never gets boring, but it's a really, I think, exciting time to be in this space. It's a really pivotal time. So Anders, thanks for joining us, and thanks for all the hard work that you, Jesper, and the team at BCG did with these reports. Maybe looking back to just the high-level overview provided from the reports and the scenarios, and thinking back, because those were published, and certainly a lot of the heavy lifting was done before Glasgow, really, and what came out of Glasgow. So in your reflections on what actually came out of COP26 and Article 6 and your scenarios, do you have anything you'd like to elaborate on with respect to the reports?
No, I think, there was a lot of anticipation, I think, throughout the year to what COP would bring. And if I take my client hat on and you could say the multitude of clients that we had looking into the space, I think it was both, you could say, an order of anticipation, right? So people were anticipating something to happen that would you could say, signal more clarity, but there was also an element of uncertainty. And I think that was one of the catalysts that Bill and us and team, we sat down when we started writing this all the way back in, you could say, January, February, earlier this year, where we started to look at, you could say, the different scenarios and said, well, how important is it, right, when we are looking across the board? And I think what we found was, irrespective of scenarios, the market would grow, and it would grow significantly, right? I think almost it was very difficult for us to not get a market that would be material in size. And at least we came out of that exercise with a strong confidence saying, well, the market is here, and it will grow irrespective of, you could say, governmental agreements and what have you. And I think that has very much also been validated throughout the summer process. But I think now that we have Article 6, you could say, sending a very strong signal. I can just say in the last 2-3 weeks, we've been absolutely flooded with requests and you could say intents of moving stronger into the market. It goes across actors that are looking to buy. It goes across developers that are looking to scale. It goes across financial institutions that are looking to basically provide more efficient and better funding. It's market infrastructure that's trying to provide a more seamless, you could say, link to markets. And last but definitely not least, it's regulators that are trying to say, hey, how can we build on this, right? How can we build a market that first of all, you could say is compliant with the rules and regulations, but also that can facilitate an ease for companies and our, you could say, corporate actors to get toward net zero. So I take it as a tremendous, you could say, vote of confidence and also, you could say, an mechanism that will help facilitate the next generation of growth, right? And the scale to what we saw across the scenarios as getting to the first gigaton, and as Jesper mentioned in the intro, visioning how we're going to get to multi-gigaton, you could say, in terms of market scope. So very, very positive outcome. Now, I would also say that when we have looked at a lot of this, the devil is in the detail, right? And I also have companies that are coming to me saying, well, now that we have, you could say, a stronger linkage and a stronger direction towards ITMOs and towards, you could say, double counting at the governmental element, how does that leave, you could say, corporate actors and some of the, I wouldn't call it Wild West, but some of the fragmentation that we see in methodologies and standards out there. And I think that's going to be one of the challenges, is to translate all the mechanisms and everything that we've seen into you could say a coherent and consistent set of detailed implementation of rules that make it easier and simpler for companies to with confidence be part of the broader market.
Great comments, Anders, and I think that actually sets the stage quite perfectly for our the next section to actually delve into what exactly this means for business and customers who are actually participating in the voluntary carbon market, or who are giving some really serious consideration to offsetting strategies and what to do. And especially for newcomers, it can be kind of overwhelming to navigate this space, right? And I think that I will say, to just put a fine point on the COP26 discussion though, watch the space. To echo Chris's comments, to not just say a call to arms, but now is the time to really become engaged at all levels, including across capitals. So state level, province, certainly national, like jurisdictions. When you look at those updated nationally determined contributions that have been coming through, and we're well over 150 now, the majority of those have some kind of reference to an interest or, desire, or frankly, a need to use international markets and cooperation to reach their goals or enhance ambition. So yeah, busy days. But okay, let's think about, again, business customer perspective. We have all this ambition, these corporate net zero targets. There's growing scrutiny about how companies are using voluntary markets and carbon credits as part of their decarbonization strategies. So how are you and your colleagues really responding to these concerns? And I think there's some very valid concerns. So how do you authentically communicate to a variety of stakeholders, be it media or in NGOs or investors or other companies, about the legitimacy of using these markets, the voluntary market and offsetting strategies? Chris, I'd love to hear from you first, and just you and TNC, and then we'll go to Bill after.
Thanks, Katie. Yeah, a really important topic. Maybe I'll say a few things to sort of set the scene of where we see the lay of the land and how we're thinking about it. So I think it's fair to say that the voluntary carbon market has probably spent most of its time to date, the last 15 or 20 years, really focused on supply side integrity. Are these projects delivering the climate benefit that they claim to be? But this point that you flag here, Katie, is very much about demand side integrity. When's it okay for a business to be using a carbon credit? When's offsetting okay? When's it not okay? And I think that topic has gained rapidly huge prominence in the last 12 or 18 months or so. And sort of, as you flagged, rightly so, we just don't have any time left to tackle this climate crisis. So we have to be sure these credits are closing the emissions gap. Now, during the past sort of 12 or 18 months or so, a number of high profile sort of global initiatives have aimed to provide some clarity here. Folks, I'm sure, have heard of initiatives such as the Task Force for Scaling the Voluntary Carbon Market, or the Voluntary Carbon Markets Integrity Initiative. We're not very good at setting up snappy titles in this market, but that's a side note. But also, as you heard earlier from Jesper, organizations like the Science Based Targets Initiative have shared some initial kind of guidance at a high level for how they see credits fitting into their framework. And a number of you may have seen similar sort of thoughts put out by organizations like the World Economic Forum or the World Business Council for Sustainable Development. But two things about that little list I've just sort of reeled off. Well, three things. One, it's incomplete. There are others putting in their views here. Secondly, none of them have really got to the end of their process of saying, here's the framework, here's the rule book. And so thirdly, I reeled off 5 already. There are others. So there's no single universally adopted best practice yet. So we're sort of in this period where we know we need to tackle this issue, but there isn't a universal best practice guide that is kind of there ready off the shelf that everybody has sort of signed up to around the world. I think it's also fair to say that, organizations such as ourselves are really kind of leaning in hard. It's a big focus for me and my team in the next kind of 6 months or so, is to really try and give this clarity to businesses. But on the face of it, I suppose, then it might be sort of challenging to think, well, which way do I turn here? Where do I go? And look, some of the positions at a very detailed level across those that I mentioned, they do differ. But I think at their core, they all seem to share some common criteria for businesses to adopt. So sort of three things. One, set net zero by 2050 latest as a long-term target. And then you need an interim target, perhaps the next 5 to 10 years, that's aligned with that pathway. You need a meaningful plan for how you'll achieve this, particularly that interim target piece. And you need to align all of your business activities around this. So that would include things like executive remuneration and how your lobbying and advocacy programs are showing up. So, I think despite that uncertainty, I think there are some core things for all businesses to sort of hold on to as to enable them to move forwards with confidence there. The last thing I want to say is often carbon credits change hands multiple times before being used as an offset. So companies who both use and transact credits need to think not just of whether they meet these criteria, but whether the companies they're selling to do as well, and how they will monitor this. So that's I think a relatively unsolved challenge in the market, and again, something that we're really working hard to provide solutions for businesses in the coming months. Back to you, Katie.
Thanks, Chris. Yeah, and your team is working really hard, including across, well, certainly the TSVC and the Task Force for Scaling the Voluntary Carbon Market, now known as the Integrity Council for the Voluntary Carbon Market, ICVCM, but still really nascent global mechanisms that are looking at driving, ensuring integrity for these markets, including the demand side of the equation, which is relatively new, right, compared to the supply side integrity piece. Bill, really curious, and I'm sure the audience is, about Shell's journey in this. It's obvious there's scrutiny for all major industries, certainly Shell and oil and gas peers. But how are you and the team really communicating about your use of the voluntary carbon market as it evolves over time, and just the use of carbon credits as just a part of your core decarbonization strategy?
I mean, I think a lot of the criticism about using offsetting certainly arises if that is all you are doing. If that is the net, if that is the sum collection of your activities, then it's unlikely that you're going to play well in the public square. Which, at least here within Shell, one of the things that I think we endeavor to be very clear about is that the focus should be first on avoiding. Look, I mean, at the end of the day, there is a budget. Let's call it 1 trillion tons of greenhouse gases, or specifically carbon dioxide in the atmosphere where we're limited to. So if you can avoid adding to it, that's the first step. Second step is that if you are adding to it, how do you reduce it through actions within your value chain, right? As I noted in the intro, one of the challenges though that you face is, are the solutions available today to do those? I mean, one of the choices you're then faced with is, are solutions feasible in a way that enables you to deliver a footprint that is in fact zero today? And that's usually intractable because you don't have the technology or you don't have the economics. So what can you do today? And that's, as I said earlier, where offsetting comes in. Now, the criticism often is labeled that if you offset today, you basically don't have to do anything tomorrow. Let me just come back to something Chris said. Paris is very much about a pathway to carbon neutrality. If your actions basically say that today, tomorrow, all the way to 2050, you're going to emit and offset, that's not consistent with that trajectory or with the philosophy of Paris, or indeed, as Shell has stated repeatedly, the need to avoid, reduce, and compensate. Through time, the need to compensate should be reducing. An effective decarbonization strategy will use high quality credits, and expect that through time, the need for those will reduce as alternative sources of energy become available. So the trajectory, the pathway, is just as important as the tools. And it's that combination which then gives legitimacy to the way in which you achieve carbon neutrality. Or indeed, as some customers that we work with have begun to highlight, creating the potential to go beyond that and indeed getting to negative emissions. And a couple at the very forefront, not just carbon neutral in the year, but being carbon neutral across their lifetime. It's always good to have customers who are chasing the frontier. So hopefully that sets in context the way in which we look at it. So to summarize, avoid, reduce, then compensate. In the context of a clear trajectory to carbon neutrality. Hope that helps.
I think it's really helpful and crystal clear. Thank you, Bill. And Chris, I'm going to be circling back to you in a moment to talk about mitigation hierarchy issues, and also I'd love for you to highlight the brand new report actually that TNC worked together with the CI and others. But before I do, on the procurement strategy, the carbon credit procurement strategy, Anders, you work with a bunch of different clients out there and help them navigate this space. So what's your main advice and guidance on companies, probably many on the phone or on the webinar today in the audience, some guidance for them on the carbon credit procurement strategies that they want to develop?
Yeah, no, and to start it off, I very much agree with what Bill said about the hierarchy, right? We are also crystal clear that you could say compensation is a residual measure, right, and should be treated so in a net zero decarbonization pathway. I think that's incredibly important also for the recognition and for the integrity of your decarbonization pathway. So that should be the starting point of any, you could say, compensation action. Now, I think the second question that companies come with is what, everybody understood we need, you could say, high quality carbon credits. That's been a mantra. I think everybody agrees on that. But what constitutes, you could say, a high quality credit, and how do we evaluate different credit types and different credit, you could say, choices in that context, I think is the second question that they ask, right? Because they all been told that we need to basically come up with a high quality credit. We want to make sure that we can, our you could say, entire scheme can withstand, of course, public scrutiny as it should. So in that sense, that's typically the second point that come across. And when we face that, we are very clear on this, right? That in today's market, I mean, there are many manuals out there. We've been working also, I mean, yes, by myself, of course, with WWF and others in laying out our interpretation also. And I understood, of course, that Chris did the same. But when we're looking at the hierarchy of removal versus avoidance, we're looking at the hierarchy of you could say nature-based versus engineered, which is typically our matrix. We have a tendency to say that what is basically removal and engineered are typically the high quality and you could say the platinum grade credits, because everybody can agree that they have very little, you could say, conflict when it comes to both leakage and additionality, and there's most certainly not any conflicts also when it comes to permanence. But as we move into that hierarchy and we move downwards towards the avoidance side and on the nature side, that's typically what has, at least in history, been criticized as you could say credits that have not at least withstood the test when it comes to scrutiny of NGOs and other important stakeholders. So we typically advise clients to be on, you could say, the safer side of that spectrum, and what that typically constitutes is that the lower grade of credits should be credits that to some extent respect both those constraints and to say are effective credits for, you could say, the offsetting and as a whole. And then the last question, of course, and I realize we're not going to have time to dive into a lot of detail, but what is the approach, right? Are you going to buy directly from projects? Are you going to buy through intermediaries? Are you going to structure, you could say, your own portfolio? Are you going to have a more concentrated portfolio? And without going into too much detail, I would say that there are choices to be made, but a big part of what determines your choices is the scale of your portfolio. So the bigger you could say your offsetting need, of course, the bigger legitimacy there is to go alone or go with a partner to build a broader portfolio. The smaller you are, the more likely it is that you're going to choose, you could say, a strategy where you're going to have more intermediary support in terms of structuring your portfolios and help to build both resilience and also build, you could say, leverage the capabilities that exist out there. And luckily, there are a lot of companies that do that in a very credible and you could say transparent way as well. So there are a lot of discussions we at least are having with clients in that regards.
Great. I wish we had more time. This is going by fast. But you touched on it, the mitigation or hierarchy piece. So I mentioned this brand new paper that came out that Chris and his colleagues, WWF actually was involved as well, so TNCCI. And I'd like Chris to highlight some of those issues. It focused on natural climate solutions. And I also, Chris, want you to touch on some of the concerns, some legitimate, right, concerns, and some uncertainties related to natural climate solutions broadly, and then some specific considerations related to REDD+, reduced emissions from deforestation and degradation. And with the context of how do companies make sure they're picking the right projects, right, or at least can properly navigate the options with confidence and the risks with confidence. So Chris, over to you.
Thanks, Katie. And I don't think I'm going to cover all of that. We could do much more than 13 minutes just on that. So I'll be brief, and then we can dive in. Like maybe I'll start with that paper. Thanks for mentioning it, Katie. It was a paper published in a journal that's called Nature Climate Change, and it was actually published just a couple of weeks ago. And it tried to lay out in the context of natural climate solutions, so using nature as a tool to help with the climate crisis. The exam question we were thinking about was, is there a hierarchy in the way that we've been thinking about the mitigation hierarchy here? So is there a natural climate solutions hierarchy? And the paper really thought about three things when it thinks about a potential hierarchy. The first is thinking about the time frame. It really kind of focuses in on the need to think about this next critical decade to tackle the climate crisis. So where are we going to get the biggest abatement in that sort of a time frame? Secondly, given that magnitude of opportunity, what portion of that do we think is cost effective relative to other solutions we've got to tackle the climate crisis? And then third, what are the broader co-benefits that these different natural climate solutions can offer, thinking about the broader opportunity for them to help support a number of SDGs. And the way we think about natural climate solutions then sort of fell out into three categories with a hierarchy across those three. At the top is protect. So the thing that came out as the biggest cost-effective opportunity with the most co-benefits globally is protecting critical ecosystems that we still have left around the world. Secondly, then comes manage. So how do we better manage working lands today, be that forests or agricultural lands? And then last, but by no means least, and I'll say a little bit on that, is restoration. How do we restore degraded and destroyed natural lands? And so the removals really mostly reside in that last piece, the restoration piece, which interestingly is the element that this paper is suggesting the world might think about coming to last. So protect first, better management second, then restoration. So I'm going to pivot a little bit to some of your questions there, Katie. Look, these natural climate solutions and REDD+. I think along with the broader voluntary carbon market, there have been bumps in the road, to coin a phrase we've heard already on this call. I think I am, however, increasingly optimistic. I think the first thing to say is we've come a long way in the past 20 years. I think some of what is left is actually more of a perception gap rather than there being these huge risks necessarily across the board with nature-based projects anymore. And in fact, that's been a lot of work that our colleagues have been contributing to over the recent years, is enhancing the scientific underpinnings for such projects. So I think we've got better data, better tools. We also need these natural climate solutions. We need REDD+. REDD+ sits at the top of that mitigation hierarchy I just talked about of nature as a climate solution. And the IPCC sort of validates that. We can't get to 1.5 degrees without nature. I think a lot of the risks lie in inconsistencies, therefore, in implementation, rather than some broader underlying inherent risks. And that does apply to all, whether nature-based or others. But, you know, there are some things to bear in mind with nature-based projects, most notably permanence. If I plant a forest over here, how do I really know it's going to be here in 20 years? Leakage is another one. If I stop people chopping trees down in one area, are they just going to move down the road and chop them down in another? And then with these avoidance, these protect projects that are at the top of that hierarchy, setting these baselines. So remains something that the market continues to enhance and evolve how we approach that, to ensure that we're really taking in the best, latest science, to ensure that's done with integrity. But that risk of setting those baselines, is one that's popped up a number of times over the years. And look, my other reason I'm really hopeful is not just that I think that a lot of the risks are more perception than real, but actually those that remain, I see a market that is extremely alive to all of that. We're talking about it here. There was lots of conversation at the COP about this, and I think the market's working really hard to deal with those risks, whether it's the standard setters, project developers, buyers. There's always more to do, but I really see a market committed to this continuous improvement. So I think for businesses, how to engage, I think a lot of the things that you just heard there apply here, about thinking about your capabilities, thinking about your risk appetite, and thinking about specifically what you want from carbon credits. How are you diligencing suppliers? How are you ensuring you've got strong relationships with your suppliers? So there are some specific things to think about, but I think the principles you heard previously from Anders all apply here as ways to manage those.
Great points, Chris. Thank you. And I am looking at the clock, and so we have less than 10 minutes. Questions are coming through. We have some really great ones. So it's not over yet if you still want to add some into the Q&A. But first one, and I'm going to read this all. There seems to be a huge disconnect between financial community and those in the carbon generation market. The financial community is talking huge volumes and dollar values, and yet to get protocols, contracts, consultants, verification takes significant time, work, documentation, verification is very slow. How can all this be sped up? Volumes increased with credibility, contracts, and consistency. So there's a lot to unpack there. We don't have time to go through all the different layers, but I do think that the disconnect between financial community and the carbon market space is quite valid. Anders, I see you shaking your head. Do you want to take the first bite at that one, and maybe Bill after?
Yes. I mean, it's funny. We just published 2 weeks ago a joint report with GFMA, which is the Global Financial Markets Association, on exactly this. And the stance, and of course, having worked with a lot of these companies, I know that the process is slow, but they are increasingly embracing this space, both as a you could say an area where they need to grow, right? They need to provide more simple documentation and more simple requirements to make projects bankable, and to get adequate financing. So although I think there is a disconnect, I do feel that disconnect is narrowing quite rapidly, and I do think as we get more infrastructure, as we get more clarity on future guiding rules, I think you're going to see the financing not becoming as big a constraint as it probably has been in the last 2-3 years. And similarly, so as buyers are opening up, and Jesper can testify to this as well, right? That we are getting asks for pretty significant purchases, right? Bigger scale, they want bigger projects, bigger impact. I think the combination of you could say access to finance, more smooth, you could say, documentation and the bigger projects will make it a lot easier to scale in the size. So although it feels maybe at the onset that there is a disconnect, I do feel like there's a momentum that will narrow that in the near future.
And then what if for follow-up, then what if they say, and we want only removals?
Well,
yeah.
Yeah, exactly. And a big part of that will be the case, right? I mean, we see that, of course, the DAX are getting a huge amount of financing and funding and an appetite from buyers. If you look across Climeworks and carbon engineering, but that's not the case. I think we're also seeing advances in REDD+ and you could say blue carbon. We see regenerative agricultural practices, whether or not we're talking Indigo type or we're talking Agora Alliance or whoever is cultivating the space. I mean, the nature-based solutions, I think, is a space that everybody recognizes will need to grow rapidly and at scale. So for me, at least, I see the momentum across the board, not only on the very, you could say, end of the quality spectrum, but also on the broader range.
Perfect. And Bill, anything to add to that, and also the new wave of considerations related to co-benefits, right? Not just mitigation or low cost, the co-benefits piece that has to be baked into some of these considerations.
So let me just unpack two parts of that. And so the first one is signals that stimulate supply. I think one of the ones that's really crystallized in the last 6 months has been the advent of a forward price. Admittedly, it's a short-term forward price for voluntary contracts, but it exists. 12 months ago, it didn't. And the drumbeat of activity around that forward price and its flirtation with forward years is gone from being zero to starting to give it some degree of credibility. So when you talk about financing, bankers like clarity on price formation, and they're starting to get that. Admittedly, 12 months out isn't a lot, but as that grows and the credibility emerges, then that will also address one of the things that creates the connect back to the original question between financing and scale up. So that'll be an aspect that comes in.
I have a couple more questions before we wrap here, and I think actually a really important one is maybe, Anders, just around the price discrepancy, like really quickly, but around the price discrepancy that we're seeing, because it really certainly they don't, $1, $2 here, and then up to $100. So very quickly, Anders, then Bill, we'll go back to you, okay? And then we'll wrap the session. Anders?
Sure.
Yeah, so absolutely right. So I feel like at least within the comparable bands of quality, we have comparability of prices, and we're seeing convergence again, right? Where I think everybody who's in the market right now understands that we cannot get, you could say, adequate compensation for $1 projects, right? It doesn't even begin to cover co-benefits that would be required to create a credible credit. So we start to see convergence around some base qualities, whether we're talking about Verra as a full year credits or we're talking about the comparable with gold standard. We start to get reference prices, and we see, of course, that the band for different credit segments starts to converge. So I think on that we then have lighthouses that provides at least indications of where a fair value would be for buyers and sellers. And then, of course, we have credits where there's a complete disconnect. So if we talk again about, you could say either bioenergy or direct air capture, where we're talking, anywhere north of $200, $400 per credit, has nothing to do with, you could say, compensation per se, but it's funding a learning curve and driving down prices for a future market that will exist in 10, 15 years time. And of course, we see companies doing that, but we're talking niche grades and niche qualities. So I think generally we start to see that in the space that there is convergence and adequate transparency that makes it easier for buyers to understand, are we paying fair value? Are we underpaying? Are we overpaying? Right, and get some credibility into that decision making.
Super, thank you. Yeah, and Bill, maybe actually that complements what you were going to say before you left us. Did you want to wrap your comments?
Yeah, I'm not sure where you lost me, so apologies. But I mean, to me, we are seeing confidence start to emerge in terms of where pricing tiers are for quality, not just in the present, but into the future. And that bolsters confidence for developers to move into a place where they're prepared to put capital to advance projects. And to me, that becomes one of the key things that lends credibility of the ability of supply to meet demand. So.
All right, so we have one last have to do one last question to all of you, and I think it's fair to wrap this up. Now you have to make it crisp though, and really resonate with the audience. But the question that comes up, including today, is this all just a distraction? So voluntary markets and credits, all distraction from the real job of decarbonizing? Is it all just greenwashing? So from each of you, just very brief 1 or 2 liners, and then I'll say some final parting words and we'll wrap. So Chris, you go first.
Thanks. Not if it's and. This has to be about and. This is about companies decarbonising and additionally financing and supporting low carbon projects and programs around the world. If we get that right, this is about doing more, not doing less.
Anders?
Fully agree. I think, the proof is in the last 2-3 years, empirical evidence, right? We've had more capital flow into areas where we absolutely need more capital to flow into, tackling difficult, you could say challenging, you could say abatement in areas that would either not have the regulation to support or would not be you could say qualify for support under normal circumstances. So for me, absolutely it adds value, and as Chris was saying, absolutely it's an and question. I think most corporates actually take it as an and question. I have had very, very few conversations where people have you could say put it up as an or.
Right on. Bill, final word.
Definitely an and question. Look, to me, offsetting, go back to my opening remarks, is an immediate way to address emissions, while technologies to avoid and reduce, they develop at scale across value chains. So that's, it's that combination of activities that is the crux of how you actually get a credible pathway to delivering Paris. Let me just call it there.
That's a great way to end. I want to thank all of you so much. We have to draw this to a close. We're going over, but special thanks to our speakers, to Bill, Chris, Anders, and Jesper. And thank you all for those in the audience who joined us today. So wherever you are in your organization's path to net zero, including if you're developing your own decarbonization strategy, we hope you found today's discussion very informative, and there's lots of discussion and working together ahead. If you want to learn more, there will be a follow-up email to all registrants in the follow-up from Shell that will be circulated to all participants. And this will include links to the Shell BCG reports and also some contact information if you want to have any direct follow-up. Finally, we'd love to hear your feedback from today's webinar. So there will be a survey link that pops up on your screen, and we'd be grateful if you have a chance to respond to that. And with that, thanks again for joining us. Stay safe, be well from wherever you are in the world. Take care, and thanks again. Bye-bye.